Hello everyone, my name is Vicente Cabrera and I'm a senior in the AIM program covering International Information Technology sector. Today I'm going to pitch Kinaxis, ticker symbol KXSCF. Kinaxis is a leading provider of cloud-based supply chain planning software. The firm's core product is Rapid Response, which improves supply chain analysis and offers a holistic view of the entire supply chain to its clients. Kinaxis operates through four segments: SaaS, which is software as a service, which makes up 62.1% of 2019's revenues. Professional services, which makes up 17.5%. Subscription team licenses, which makes up 13.7%, and maintenance and support, which makes up 6.7%. Kinaxis derives its revenues from the United States, 65.6% of 2019 revenues, Canada 2.7%, and China 2.5%, as well as 67 other countries. The company was founded by Duncan Clennon in 1984 and is headquartered in Ottawa, Ontario. Now on to my recommendation. Kinaxis completed their IPO in 2014 and have become an impactful player in the ERP software industry. Kinaxis has shown impressive growth demonstrated by 27% net revenue growth and operating income growth of 17% in 2019. In addition, Kinaxis expects EBITDA in 2020 to grow 47% year over year, EBITDA margins to grow by 40% to 57.7% margin, and SaaS revenue growth of 22%, which will all lead into an increase in net profit of 14% year over year. Additionally, Kinaxis has a large backlog of revenues they expect to recognize in the future that total $339.4 million. This backlog has grown 43% since the last quarter and has increased consistently over the past several quarters as they continue to sign multi-year subscription contracts. Kinaxis' main product is the Rapid Response, which is a single cloud-based SaaS platform that creates a fully synchronized supply chain planning capabilities that provides sales and operation planning, control tower, inventory planning and optimization, capacity planning, supply planning, and demand planning. What differentiates this product from its peers is that it's the ease of usability and flexibility that it offers. With Kinaxis positioning in the current environment, along with their current investment in AI capabilities, it is recommended that Kinaxis be added to the AIM International Equity Fund with a price target of $200.35, representing a potential upside of 56%. Now moving on to my first driver, COVID-19. Due to COVID-19's operational disturbances, companies have been forced to reevaluate their cloud applications and supply chain management strategies in order to handle the external challenges and yet remain robust enough to meet the changes in their supply chain. This puts Kinaxis in an ideal position by offering Kinaxis Rapid Response, which gives companies the agility needed to meet these changes in the supply chain and the solutions to address unique and extreme cases. In addition, Kinaxis SaaS subscriptions secure more than half of the revenues, which has positioned Kinaxis to withstand an upcoming market turmoil. Because of their recurring revenue streams, any downturn in new sales will not immediately impact the operations of the company and will not considerably influence the success of the company. COVID-19's impact on revenues have been projected to slow Kinaxis' growth to 15% in 2020 and 18% in 2021, but it is then forecasted to grow 30% in 2022. Now onto my second driver, AI capability advancements and Ruby Cloud acquisition. Demand planning applications have allowed companies to create statistical forecasts and demand plans collaboratively. Machine learning has been a big part of this application, and the rapid response offerings has allowed the system to learn to identify signals and discover short-term demand changes such as weather, social media sentiment, competitors, point of sale data, etc. Kinaxis' AI algorithms was tested by looking at 55 products distributed through 140 retail locations in a 2.5-year span of historical data, and the results concluded that with the system incorporated, the amount of stockout days would decrease by 60%, and inventory would also decrease by 7%. Kinaxis has realized the value added from machine learning. So in July 2020, they acquired Rubik Cloud for $60 million. Rubik Cloud is a world leader in AI software for enterprise retailers. This acquisition has helped complement Kinaxis' system and broaden their capabilities for their consumer packaged goods and retail clients, as well as bring trusted and enduring partners such as Microsoft, Google, and Salesforce, and add $13.8 million of revenues. Now onto my third driver. I know I only had two in the write-up, but that was because I didn't have space. Um, so for my third driver, it's immature margins. SaaS operating margins for mature companies, the average of the industry is about 29 to 35%, and Kinaxis' operating margin is only at 18%. And in terms of gross margins, the industry average is 80%, while Kinaxis is at 75%. This shows that the company has room to grow their margins to increase their bottom line numbers. Now into my valuation section. In order to reach a price target for Kinaxis, I conducted 4 different valuation metrics. Firstly, I did a 10-year DCF model using a terminal growth rate of 2% and a WACC of 7.76, reaching an intrinsic value of 192.11. I also conducted a sensitivity analysis on the terminal growth rate and WACC, which ranged from 150.57 and 277.43. Additionally, an EV over EBITDA 2020 multiple of 116.03 times was reached, resulting in an intrinsic value of 293.15. An EV over revenues 2020 multiple was also conducted, which I got 12.87 times, resulting in an intrinsic value of 133.86. Finally, a PE 2020 multiple of 113.67 was calculated, resulting in a value of 258.74. By weighing the 4 models 50, 20, 10, 20, a price target of 219.82 was reached, resulting in a 56% upside. Kinaxis also does not pay dividend. Now moving on to my risk section. Kinaxis has some risks that we may see in the future that we must take into consideration. Recurring revenues. Kinaxis relies significantly on recurring revenues, so if any recurring revenues declines or contracts are not renewed, the company's future results could be adversely affected. Privacy and security concerns. Evolving government regulations and consumer data privacy could adversely affect the business. In addition, any security breach could delay services and harm the reputation of the company. And finally, expansion efforts. The company's efforts to expand outside of North America could create additional risks associated with international operations. Further, if the company fails to develop widespread brand. And on to my management section. John Sicard has been the president and CEO of Kinaxis since January 2016. Prior to moving into his current role, Mr. Sicard had over a 23-year tenure at Kinaxis as a key contributor to the architecture and development of Kinaxis and has held several senior management roles, including Executive Vice President of Marketing and Development, Chief Operating Officer, and Chief Strategy Officer.